Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On tonight's show, the preoccupation has to be, should you be scared about what's going on in Israel and Iran? How will it affect the stock market? Are there buys that you should be thinking about? And are there stocks you should be dumping because of the fears around what's going on in the Middle East? To kick off, we have Lieu of TenCap. And June, of course, always sees negative events as buying opportunities. Will she say this is the case tonight? And then we'll talk to Michael Wayne of Medallion Financial. Now, Michael has been one of the best tech callers I've ever spoken to in all my years of covering the stock market. He introduced me to companies like Ordinate and Megaport when no one ever heard of them before, and they did very well. What's his current take on what tech stocks are doing and what they will do in the future? And finally, one of my favorite economists, Michael Knox, chief economist at Morgan's, the stockbroking firm in Brisbane and right around the country. Michael's a really smart guy, and his calls on the Australian dollar have often been so on the money. I couldn't help but get him on the show to talk about three or four things. One is how scared we should be about the Iran-Israel impact on oil prices, what's going to happen to the Australian dollar, and interest rates. What is he expecting for interest rates? All these big issues will be tackled very eloquently and very intelligently by Michael Knox. So let's kick off now with Lieu of TenCap. Thanks for joining us, Lieu.
Thank you for having me, Peter.
You were saying to me before we came on air that we have this regular rendezvous whenever the market is really in a scary situation. I think the Trump sell-offs, the Liberation Day sell-offs, and now we've got this Iran Israel problem. And you often say to me when these problematic days come around, you say it's a buying opportunity, but is this a buying opportunity?
Oh, absolutely, definitely. I don't think it's any different. Actually, thinking back, I was wondering why it's always seems to be when we talk about the market, it seems to be the worst. Because it's Monday. We often catch up on Monday because things always happen on the Friday, and then weekend it got worse, and then on Monday is always a major sell-off. That's before the U.S. market open, and then when U.S. market open by Monday night, it's often people become more pragmatic, and then see through the event, and then Tuesday is a rally day. So I think that's why it's always the weakest day. But it is good buying opportunity. To be honest, I think the market is sort of responding not as bad as we, initially saw on Friday, Friday lunchtime when it first hit. We saw market was sell off a lot and then sort of gradually recovered. So, we are seeing broader sell off. But look, it's not that bad. It's quite orderly. So I do think if there continue to be more weakness, you just buy the companies you top up on the companies you always want to buy. I think it's great opportunity. And of course, we got M&A happening in the background as well today. So, the market condition is not too bad.
Talk about the M&A today.
Yeah, so the M&A is Santos now finally under bid. And, it's a big price premium. And, yeah, that's with the Abu Dhabi, investment corp making a big bid. And then the company actually has, agreed to the price because it proven to be a good premium. The only thing is the share price at the moment is not trading at the even remotely close to the bid price. I think share price trading at something like something like $1, something like, almost 20% below the bid price. I think it's a represent good buying opportunity. People a bit worried about the FIRB approval. Clearly, the Australian asset, it is pretty stringent approval process. But I think it's, there's a way around. The Santos management is very confident that they will get this through. So, yeah, but regardless, it's been more positivity for the marketplace. And we're seeing Woodside share prices moving higher as well. Just obviously there's an unrest in the Middle East, always great for oil prices. But, I think people thinking, what if when Santos gets taken out, Woodside is the only big major oil companies left.
Yeah, exactly right. Not only the only breed, the best of breeds as well.
Mm.
So, so how does someone play this? Does someone buy Santos hoping that they actually do materialize the higher prices on offer?
Yeah, I think given the price, given the discount it is trading at, it is actually pretty reasonable. So you're getting a double-digit return if it does come through. And to be quite frank, you won't know until for quite some time. So
Yeah.
from now until then, it is pretty safe to be there as well, and you get good leverage into higher oil prices. They will just make more money. So I actually think it looks pretty good at this level.
Mm. And look, when you have an offer where the board says no, I remember many years ago Renee Rivkin said to me, the first offer is often not the last offer. But in this case, you've made the point that the Santos board have said, yes, this is a good price.
Yeah, that's right. So the company, it's a friendly deal. So companies already agreed to it. They think it's pretty good. Value the asset a pretty good value. And yeah, seems like everything's quite well advanced. And then the management is pretty confident that they will get through the further approval. Clearly, they've done a lot of analysis, and there's been tons of work done behind the scenes. So yeah, so that's why it's a bit of surprising the market is decided to take a stance that there's a bit more uncertainty. There's potentially Woodcock could be for right, and then there could be other bids, but of course it's a big ticket. So we kind of just the deal itself is what we people assess it
Yeah,
as.
yeah, yeah, gee, well, it's the first time in my life when I thought to myself, you know what? Jimbo Liu might actually beat me in an optimism competition. I know you're an optimistic person, but I've never actually thought that you could threaten me, but I got a funny feeling you might beat me when it comes to optimism, and I like that. I like that.
But that's what share market is. You got to buy future earnings, right? So you've got to be optimistic to expect what's to come. But at the same time, look, you got to be pragmatic. If it doesn't work, you need to move on to the next opportunity.
Yeah. Okay, let's go to a burning question for many people, and that is, can the CBA share prices keep on going up, or is there going to be a time when you've got to take a bit of profit and wait for the analysts to be right? Analysts think 45% fall in Commonwealth Bank.
It's not falling 45% unless we're in a world of free fall, the market uncertainty and everything. We're past that. It's not going on free fall. The best thing it would do is probably grind higher, but you probably would do a little bit less than what market would do. So share market, I think, will go higher. This one might just grind a little bit higher because it is expensive, but it's not going to have that substantial fall. So I really think for investors, it depends on what your horizon is. For retail investors, where cash is the king, and you can always take some profit and do something else with it. But for fund managers, we got a benchmark of ASX 200, and CBA is a big part of that ASX 200, so I can't sell it. Unless I find something that's gonna go do better than CBA, then I will might sell a little bit. So it's a little bit different. Hence why share price keeps going higher. It's not mom and dad going out rushing out and buy it. It's actually the institutional investor. We have so many foreign investors keep buying CBA because it represents the Australia index. Our economy is okay. At the same time, Aussie dollar so cheap, and the investor just think, oh, it's a good chance to buy some of those things.
That's right, and also the rapid growth of exchange traded funds means, like, automatically, if I go and buy A200 or IOZ, I instantly am buying CBA, aren't I?
That's right. Something like 20 cents will go into it, right? So, and the institutional investors are exactly the same. And more recently, we had so much flow moving out of US. US has been more than 50% of the market globally, right? So institutional investors got a bit nervous with this tariff and things. So they're just moving a little bit outside. And little bit means a lot when it comes to our small market. And then they just naturally will buy more CBA, more Bramble, more West Farmers. So hence why you see it's being so strong.
Okay, let's go to the fact that we're expecting an interest rate cut in July, and some economists have 3 more penciled in, some have 4 more rate cuts penciled in. Are you looking at companies, or have you already looked at companies that you think will be beneficiaries of a lower interest rate Australia?
Yeah, absolutely. With fund manager, be a good fund manager, we have to stay ahead of them. So look, to be honest, absolutely. I think Australia is a good place to be buying this company. And recent volatility in share prices because of what happened in the US, because of the global uncertainty, it gives a great buying opportunity. You want to buy company leverage to it. It's your property trust. But potentially retail property REITs doing quite well. Your, housing related REITs doing well. Your home builders. We haven't got many pure play. You got your Stockland and Mirvac, and then we got this new IPO coming. I think we'll do incredibly well. It's called Gem Life. It's a home builder, has been doing this for decades and growing very fast. I think that will do very well. Ingenia will do well. Retailers, but retailer got to be careful because some of the consumer is patchy, so you've got to stick with the quality names. So JB Hi-Fi is pretty good. The Harvey Norman is okay, but then we just heard from Accent and a few other smaller retailer, just patchy. Retailer, they will have their trough earning probably this result, and then from here on you'll get better. So lots of linked, businesses and sectors, they will do very well next 6 months.
I was in Bunnings yesterday. What a business.
That's right, Bunnings, yeah.
What a
I
business.
love Bunnings. It's what I do on Sunday afternoons.
Yeah, yeah. We bought an orange tree yesterday, much cheaper than its rivals too, I can tell you. But anyway, so that's all right. What about a company you and I have been very supportive of, had a great week last week, namely Zip.
Mm.
Can Zip keep on zipping higher?
I truly think so. And right now, you see share prices weaker because of uncertainty, global uncertainties, and war and things. It's your buying opportunity. It's just incredible. I think Cynthia has done an incredible job turning around that business. Be focused. Australia focused on making money. US focused on growth. And that growth is just accelerating. Even though we worry about US consumer slowdown and others, it's just not happening. And they just simply keep winning share in that whole deep fragmented market.
Okay, I know when Larry Diamond went to America, there were people suggesting, "Oh, he's getting out of town because the company wasn't doing well." But ever since Larry left and is working out of America, and I think he's got some new people working for him as well, this company's done well. What is Zip doing right compared to even Afterpay? Because Afterpay's not having the same kind of, charge forward as it used to have.
Sure. I think first of all, like Zip is still very pure. The problem with business, especially fast-growing businesses, innovative business, become part of something else, always becomes harder. You got to fight for your budget. You got to, certain limits, and I think that's a big thing. So Zip is still pure. They're just there, and they're small. Afterpay grew really fast early days, and Zip is tiny. They're still tiny part of the market share, and then they can go to market where there's no Afterpay. Like there's so many areas they can go into, and they've been doing really well. So I really think it's nimble, and they still offer low base and just opportunities is a lot.
Okay. We've noticed of late that when there's negativity in the market, tech companies seem to get trashed. Well, their share price goes down. Do you see this as a buying opportunity for a lot of those tech stocks?
I think so. I think, it's interesting. In the old days, when market uncertainty is high, people want to buy tech because they're defensive. Their growth is not affected by uncertainty in the world. But these days, they get sold off. The reason being is that because tech has done really well for people. And so people just use this opportunity to take money off the table. So I think, again, it's the same thing. So it provides you with good buying opportunity into a company that earning doesn't get impacted with some of those uncertainty. They will continue to grow. Valuation is a thing often talked about. I think with the interest rate being cut in the interest rate cutting cycle, valuation is not a problem as long as the company can deliver earnings in exceeding the expectations.
Okay. Now, before we go, I call these my two favorite tech companies, and I want you to tell me whether you think the outlook is good for these two companies. First one's easy. It's Zero.
Yeah, it's a buy. It's incredible. Lots of addressable market is incredible. When they first went to UK, people were skeptical. Then they've proven what they've done in the UK market. Now they're in the US. I think the early signs of US is going pretty well. So I really like their company. And in Australia, we really have limited growth businesses that can actually proven that they can go to those markets and profitable as well. So they definitely reached the profitability hurdle. I think that definitely is a buy.
The one problem with Zero is that we think it's Australian, but it really is New Zealand, isn't it? It
That's
really
right.
is.
Quite amazing. Yeah, that's
Don't
right.
tell the
We
Kiwis
call
we
it Australia.
It's a bit like James McDonald, the famous jockey. He's not Australian, he's a Kiwi as well. One final one, and this is an Australian company with a CEO with a remarkably unique name, namely NextDC. And I think Craig Scroggy's a very good CEO. NextDC, what's the outlook for that company?
Outlook is really good. They have defied, gravity and everyone else's skepticism. They won many contracts. In fact, some of the contracts more related to the AI language training now. So, Australia and also recently they won the contract in Malaysia where they just started trying to build a foothold. I think the growth trajectory for all data center players are just phenomenal. Enormous amount of demand. NextDC is really proven to become a meaningful player there now.
Okay.
Mm.
Next time we meet, Jimbo Liu, I'm going to ask you to give me the 10 companies that you put in a portfolio for your most beloved relative, someone who you would want to get rich in the future. It's going to be Jimbo Liu's 10 top stocks to get rich. Okay.
Yeah, definitely, definitely.
Look forward to seeing you then. Thanks for joining us.
Thank you for having me. Thank you.
And that was Jimbo Liu of TenCap. Now, let's have a look at what Michael Wayne is saying about tech stocks. Thanks for joining us, Mike.
Thanks, Peter, for having me. It's good to be back.
Yeah, good to be back. Apart from talking about your holidays and all the other distractions, you're only here for one reason. We want to know what's happening to some of the great tech stocks that you put us onto in the past, ones that we've made good money out of, or when Ordinate, Megaport, then they come off the boil. Some of them making a bit of a comeback, and Megaport's had a nice rise lately. What's happening with those two companies, just to kick off with those ones?
Yeah, so Megaport and Ordinate, both companies that we do hold for clients and do hold in the managed fund. Megaport's been a bit more of a love-hate relationship in that we've sort of been a bit more active around it. I think probably for the last 4 or 5, either half yearly or full yearly updates, it's either been a 20% rally or a 20% decline on the day. However, in more recent times, it does seem like momentum has come back into the business.
Yeah.
They went, through a period where they increased their costs substantially, increasing headcount and whatnot, and the initial revenue streams that came from that weren't as good as the market was hoping for. After a bit of a disruptive period, they seem to have got things back on track, but we do look forward to the August reporting season to see what this company can deliver. But yeah, high quality business, data centers, the use of data is not going anywhere. And they're a service provider within that data space. So we feel as though that the outlook for this company should be pretty good. But we've been looking at this company for over 6 years. We've had clients investing on it. It's been a wonderful business, but it has had its choppy.
I always place it, and I was talking to Junbei Liu earlier, I always place it as a company that's like the second tier. The top tier to me are Zero, I guess, Wise Tech, and XDC. But these guys, I think in 10 years' time, will be a part of our tech furniture because they do have a lot of competitive advantage, and they're even takeover targets, aren't they?
Absolutely. And they've had the first mover advantage into their part of the data sphere. So effectively, what it allows companies to do, or the Megaport products, is to dial up and down their need for data as it occurs. So the example I always give is sort of the TAB, for instance. They know there's going to be a lot of focus and attention on their website during the Melbourne Cup Carnival. So then they can facilitate that increased demand by using Megaport services to dial up.
So it doesn't crash when people want to feel
Exactly. So that flexibility and the length of time that they've been providing that service has given them that first mover.
Yeah.
So the second one was Ordinate.
Yeah.
So this is again one we got onto very early, and there's been some periods where it was doing stunningly well. It was
Yeah.
up to above $20 there
Yeah.
at one point. 80% of all new electronics coming to market embed the Dante protocol, which is Audinate's biggest sort of product. So there's a lot of growth for this business, but essentially after COVID, there was a lot of demand that was pulled forward. The order book dried up a little bit in recent years and the market lost a lot of confidence in the company. But they did have a pretty decent update in February of this year. So if they can deliver another strong result in August, I don't think it'll take much for this company to move back above sort of $10 and then eventually in time push that $20 mark.
Gee, this is the most cocky I've ever heard you in all your 6 years of being this. Anyway, that's good. They're two companies. Are there any other tech companies that you've added to your stable or ones that have been there and I've just forgotten?
So the two most spicy, if you like, are probably Megaport and Audinate.
Yeah.
Some of the others you sort of touched upon. Xero has been a big holding for a long time for clients. Technology One has been a staple.
It's had a nice run over the last couple of years, hasn't it?
Yeah, Technology One is a business and it's been listed on the ASX for a very long time. It's probably the original ASX tech business.
Yeah, sure.
But it exhibits very strong compounding characteristics. It's had, would be over a decade now, at least, if not longer, of compound earnings and revenue growth consistently. It's a company who's got a very sticky customer base. Now, a lot of different sort of local council groups, corporates, government organizations use their services, and effectively is customized software which allows different pieces of equipment to communicate, whether it's payroll, whether it's, workflow management, all those kind of things. So it's a business, that is winning more and more contracts. Their order book looks very attractive with a lot of the contract values greater than their average recurring revenue per customer at the moment.
Yeah.
Had a very good update only a few weeks ago. So it keeps delivering. So we touched upon Xero, Technology One, WiseTech. They're probably the three staples.
With WiseTech,
Yeah.
how you're dealing with Richard's unusual approach to that business? Because I've come across a story recently of someone who worked for WiseTech, and he makes the point that Richard is very, very deeply involved in the business. But this guy said he actually interviewed me, for the job. He said, and I'm not wasn't that senior. He said, so he may well have some interesting social activities, but he does seem very much entrenched in his business.
Yeah, I mean, his personal dalliances we've tried to put to one side and focus on the
And
quality.
by the way, he's not the only business leader who has
They're the ones known about. Yeah.
That's right.
So no, there's definitely a good quality business underneath all of that.
Yeah.
And from what we can tell so far, there's been nothing illegal in what he's done.
No.
And he is very involved in the company. And ultimately, when we view a business like this, we would prefer the founder to remain involved in the company. He has the runs on the board. They recently did another large-scale acquisition.
Yeah.
They've done over 50 acquisitions over the years and had a great track record of incorporating those companies. I think like 46 of the world's biggest 50 freight forwarders are customers of WiseTech through their CargoWise product. The new acquisition will give them access to more like wholesalers and retailers. So it's a business that we think will continue to grow very quickly. And we like, again, those compounding characteristics. And until there's evidence that that's changing, we don't see any reason to turn away from the business.
Yeah, yeah. And you've looked at this new acquisition and you see it as a real plus for the organization.
Yeah, definitely. I mean, it's not small. It's 3.2 billion. So it's a very large acquisition by all means. However, it opens up a new channel of growth for them, which if they can deliver and pull it off, can add a lot of value. The problem is the business that they're acquiring has been struggling somewhat. And that, is why the market was a little bit fearful initially over the acquisition. But if they can embed it into their current systems, and I think it should be quite good. But effectively, it just gives them access to a whole new market pretty quickly.
Yeah. Okay. So that's the tech space. What about normal companies? Are there any normal companies lately?
So yeah, what have we been looking at recently? We don't mind something like a Pinnacle group. Basically, they own stakes in a number of different fund managers across different asset classes. And we just feel as though that the stable of businesses they're investing in, they're all pretty high quality. They're all performing very well. And the fund inflows have been very attractive. So You look at some of their main holdings, things like Coolabah Capital, which is very much focused in the fixed income space. They've seen enormous inflows in recent years. Hyperion, a global and Aussie equities fund manager, likewise. There's some of the Firetrail. There's a number of different quality fund
So
managers.
you're saying that the guys at Pinnacle were prepared to work closely with Chris Joy. That's a really courageous thing. Chris is your mate of mine, but yeah.
Yeah, he's enigmatic, but he's a wonderful marketer and a wonderful manager. So far, he's in the track record.
He's pretty good, man.
So that's one that we quite like, and depends on what sort of we're looking at any given time. We think, something like a GQG, another fund manager, is looking fairly attractive from a value and yield standpoint.
This year's surprised me. It's a bit higher than I thought.
Yeah, it's about 8%, maybe even 8.5%. It's trading on a PE ratio of under 10,
Yeah.
and the growth for that company seems very good, enough certainly to maintain that dividend growth over time.
What about, I think in our former days, we've talked about pay companies like Zip. Zip's having a nice run. Can
Yeah.
it keep going, do you think?
I don't know much about Zip these days. I haven't been following it ever since sort of the glory days, but
The glory days was there.
it was there, and then it came back a long, long way, and then it's picked up very nicely. They were always a bit more sort of diversified than, say, an Afterpay. They had bigger ticket items that they were lending on as well.
And they're much more careful about who they lend to.
That's right. Their credit checks were always a lot more sophisticated and in depth than a lot of the imitators or competitors. So, yeah, it's not what I've been following lately, except for the share price. I've definitely noticed that it's done very well.
Yeah, fortunately, my wife bought 40 cents.
Really?
And she keeps reminding me how smart she is. Now, because she watches the show, for us.
Cool.
I guess the final question: all this Trump and Israel and Iran, what's your view? Do you have a cautiously positive view on where stocks go in the era of
Yeah.
Donald J. Trump?
Look, we're cautiously optimistic. We tend to be like that most of the time. We do think a lot of the initial bravado when it comes to tariff has been walked back significantly. Obviously, the bond market's had a role to play in that, particularly at the long end of the curve. Things started to look pretty precarious, and Trump's billionaire mates or people that are close to him were able to get into his ear to a point where he was able to walk back some of those things. And I think ultimately it puts America in a slightly better position where they're able to negotiate improved trade relationships globally, which ultimately will be a positive. Obviously, the tax cuts are before the Senate at the moment. That would be ultimately a positive as well if they could get through. But look, there's always these global events, when looking at markets. You look back through history and you can pick any decade, there's always flare-ups, and markets tend to climb the wall of worry. The situation in the Middle East is obviously unpleasant, but it was already 13 years ago where Netanyahu was talking about the red line in the United Nations, and in some ways it's a surprise that it's taken this long to get to this point. But ultimately, we're constructive around markets. Inflation seems to have moderated significantly and is back within the box or within the band. Interest rates are on the way down again globally. I think broadly speaking, that's a positive for markets, particularly after a bit of a cathartic clean out, which we saw earlier in the year.
Okay, one last question there, and it's a double barrel. One is, are you suspecting that CBA share price is going to come off the boil? One, and B, is it wise to be progressively longer the likes of BHP and Rio over the next couple of years?
So when it comes to CBA, I would have been wrong every time that I've spoken about it for like 5 years almost now. It does beg a belief in many ways, just looking at the valuation it trades on relative to the earnings growth, relative to the dividend per share growth, which have been fairly anemic. There's no doubt that relative to other banks globally, CBA is expensive.
But it's a better quality than most banks.
Well, that's definitely the case. But there's no doubt there's some underlying factors contributing to this, whether it's the passive flow of money into exchange traded funds or the lack of alternatives in Australia. That's potentially a reason.
Foreign money's probably coming.
Foreign money, Australian dollars, held up relatively well. Australian market has held up relatively well. So who knows the underlying reasons, although it's not something we would buy.
Yeah.
If we held it, we would probably reduce it for those that can without tax implications, because I just feel as though in a 3 to 5 year time frame, if you're rotating out of CBA at these extreme multiples, there are other growth opportunities that will likely grow a lot more. So for instance, for our clients, and we obviously have clients that hold banks, they've held them for a long time, something like a CSL or a ResMed, which are historically cheap on a 15-year relative basis. At some point, we think that the drivers of the index will change and the banks won't be able to, or CBA won't be able to keep maintaining the rate of growth. The other question on BHP and Rio, this goes again to the other question on the banks. It's hard for that market leadership to change unless there's sufficient reason to move into the likes of BHP and Rio. And at the moment, I just don't think that there is that sort of impetus to blindly move into the commodity space. Commodities and commodity-based companies are relatively cheap relative to the market through history. But, you look at BHP, what's the iron ore picture look like? It's very uncertain. You've got Twiggy talking about the Pilbara potentially turning into a wasteland. BHP have taken measures to increase their copper exposure, and the outlook for copper looks probably a lot better than iron ore.
Yeah.
So I think in a portfolio, we're not going to do too horrendously by holding something like BHP, but we don't hold BHP or Rio in our managed funds. We hold copper exposure, but not the diversified.
Did you get Sandfire Resources one was very low?
We did actually have Sandfire, but we moved out of it probably a bit too early into Capstone Copper, which was a Canadian listed copper producer that dual listed in Australia, probably better quality assets, but hasn't done as well as Sandfire. So we didn't maximize our trade on Sandfire, although we did all right off.
Okay. I guess Donald Trump's probably picking on Capstone as well. Is he?
Yeah, that's potentially been an issue for it.
Okay, mate. Michael Wayne, Medallion Financial. Thanks for joining us.
Thank you, Peter.
And that was Michael Wayne of Medallion Financial. And now as to Michael Knox, Chief Economist at Morgans. And we want to know what's going to happen to the big issues, the dollar, interest rates, and the global economy with all of this Israel-Iran problems capturing the Middle East and also global stock markets. Michael, thanks for joining us.
It's great to see you again, Peter. It really is.
Yeah, no. We won't talk about state of origin and things like that. We're well above that kind of jingoistic battles, state against state, mate against mate. Now let's go to what we're really all scared about: Israel, Iran, and I guess the oil price implication and the global economy. Should we be worried?
I'd be right. Honestly, I don't think we should be worried. The Saudis are sort of well defended behind their own missile shields in Dubai and other places on the west of the Gulf. Kuwait, I don't think Iran's going to invade Kuwait, so I think they're safe, and I think the Emirates are safe as well.
Right.
So I don't think that's such a big problem. Iran, of course, is an oil producer, but it's a relatively small oil producer in comparison to the other ones I've just spoken of. So it's a short-term scare, but I don't think it's a major problem.
Okay, let's go to a much bigger hurricane, Hurricane Trump and tariffs. Now,
Yes.
of course, Liberation Day, April 2, wasn't April 1, but April 2, it looks scary. There's a lot of people believing in the taco theory, Trump always chickens out, which I'm sure you would have laughed at the first time you saw that. But what do you think is going to happen? Do you think he will eventually get on reasonable tariff deals and the global economy won't be as rocked as we feared? Or is that still a bit of a concern for you?
One of the more interesting performances to watch on this was done by Austin Goolsbee, who's the president of the San Francisco Fed, and he did a talk about 6 weeks ago now to the New York Economic Club, and what was really interesting, what he argued was, and Goolsbee is on the Fed the other market committee of the Federal Reserve this year. So
Okay.
that's why it was particularly interesting. So what he said was that that if you looked at what a tariff does, it does two things. It's like stagflation. If you put up a tariff, what happens is it puts up prices, and in response to that, you should increase interest rates. But it also reduces growth, which means you should cut interest rates. So the result of that is, and he was saying this before the last Fed meeting, the Fed should do nothing. And as a result of that, shortly after that, the Fed did absolutely nothing. And I think it's following that view. If I look at the growth numbers that we've currently got for the US economy this year, growth slows from over 2% last year to about 1.3 this year, most in the second half, and inflation kicks up to 3.4%. So that's sort of just moderate slowdown, but no recession, but a moderate bit more inflation. Now, I think that the Fed is going to eventually start cutting, and I think it will cut by about 50 basis points by the end of the year. But that's only 50 basis points. It's not huge. It's certainly not an emergency cut. And I think we'll cut it by about the same. I think we'll cut about 50 basis points. So if you look at what's actually happened currency-wise this year, the Aussie dollar has really been flat against the US dollar. It's gone up 2%, but the euro has gone up 10%. So I think basically there isn't going to be much price action between the Aussie and the US dollar, but I think there'll be a lot of price action between the euro and perhaps other currencies and the US dollar. So in answer to your question, which you're about to ask, should we hedge against up movements of the US dollars? Well, if you're holding US stocks, yeah, maybe. If you're in the US holding stocks, you would. But in Australia, not yet. Not until our own rate cuts have happened.
Yeah, well, financial planners always put their clients into particularly US investment products. Are you saying that you think the A dollar's probably got more upside than downside, and therefore I don't want you to recommend hedging, but I guess it's simple. Do you think the A dollar is likely to be higher than 65 cents by the end of this year and by the end of 2026?
I think, well, I don't really think it's going to be much higher by the end of this year.
Hmm.
But what happens next year is a different story. When rate cuts are over in Australia, and we've matched the US in rate cuts this year. I mean, if we match the US in rate cuts this year, there's no real reason for the Aussie dollar to go up. Maybe next year. Next year, there might be upside in the Aussie dollar relative to the US. And indeed, I'm thinking that if the US dollar economy does slow down and there are rate cuts, then the US dollar should fall, commodity prices should go up. But again, we've got more rate cuts to do, and that'll hold the Aussie dollar back.
Okay, but let's go to my final question, which links a lot of this in. You know, I want to know whether BHP and Rio share prices are going to go up for the next year. And you don't answer anything about stocks, I know that, but you do have views on the Chinese economy and their demand and what it could do for commodity prices. You've already said that maybe a lower dollar is going to be good for commodity prices. That would be good for BHP and Rio, I presume. Correct me if I'm wrong, and I know you will. But but what's the Michael Knox destroyer view on China? Well, sorry, as Donald Trump would say, China.
China, yes.
China.
China is a very large economy. I think it's only going to grow effectively at about 3.5% this year, much less than the 5% it wants to. But saying that provides an enormous amount of exported product, and it'll be harder to get that product in the US because US tariffs are 30%. But here we're tariff free, so I think one of the reasons that Australian inflation is so low, at a point where unemployment is only 4.1, 4.2%. That's very, very unusual, and I think that's because China has a vast surplus of goods that it needs to export, and it's harder to export them now to the US. So they export them to everywhere else, including us, and also all those other countries, the Western Pacific. You got to remember that Chinese growth has fallen below the growth rate of Vietnam. Vietnam is now growing at about 7%. And India, of course, is growing at about 6.5, 6.2, 6.5%. So there are now higher growth economies than China, and maybe China will be exporting its manufactured products to those very high growth. It's obviously, even if you look at the steel exports, they export a lot of steel to Vietnam, a lot of steel to the Philippines, a lot of steel to South Korea, an enormous amount of steel to Indonesia, because now they're building the same kind of big cities that China was building up until recently. So you've still got that demand for steel, but it's steel in other rapidly growing economies, and not just China. So therefore, I think there's a continuing demand for Australian iron ore and Australian metallurgical coal.
Okay. So that's the closest you're going to come to saying, I wouldn't be afraid to be invested in BHP and Rio.
Well, I think the fall in the US dollar, already the US dollar has fallen by 10% against the euro this year. And I think that continues to happen that way.
Yeah.
So the result of that is that continued fall in the US dollar must have the result of pushing US dollar commodity prices up. And so I think we're just past the bottom of the low in commodity prices in this cycle. And I think we're going to see steady rises over coming years, but they'll be more gradual than we saw in the previous boom cycles in after the pandemic.
Yeah. It's funny, I was talking to the new chief economist at BHP at a very nice dinner at a restaurant in Sydney. And he actually made the point that BHP's sales of thermal coal to India are actually quite important to the company nowadays. And so you're right in saying that our focus on China may well be misplaced in the sense that there are other economies who are doing the growth story that became quite popular, I guess, in the noughties and the late teens of 2000. But other countries, and China, in a sense, has become like a closer to a first world country. So you can't expect it to grow by 5 or 7 or 10% as it used to in the old days.
Yes, I think that's absolutely the case. I think the growth in China is being replaced by the rapid growth of the Indo-Pacific.
Yeah.
All of those countries, including India, but also, like I say, Vietnam has 100 million people in it. It's got a bigger population than Germany, and it's growing at 7%. That generates a lot of demand this year, next year, and for the next 20. That's extraordinary what that does.
Yeah. Go Vietnam, go Australia. Michael Knox, as always, thanks for joining us.
Thank you, Peter.
And that was Michael Knox of the stockbroking firm Morgans. That's the show for this week. Thanks for joining us. Don't forget, what we cover on this show is only part of the story of what we do here at Switzer. The Switzer Report has some of the best market analysts in this country. People like Tony Featherston, former boss of Australian Financial Review, James Dunn, one of the most well-known markets commentators this country has ever produced, and of course, myself and Paul Rickard, and a whole host of others who will give you insights that you won't get on the TV show, but you'll have to become a subscriber to the Switzer Report. Go to switzerreport.com.au. Thanks for joining us. See you next week.